Okay, welcome everybody. Welcome to this week's market outlook. The last week we're going to touch on it was it had its ups and downs. Market just trying to work out a happy medium between how resilient the economy is going to be in the light of the aggressive interest rates and whether or not there's going to need to be further tightening, and if not, how the economy is going to respond and how the overall health is going to stand now that the full effect of these rising rates are going to start to kick in. So last week it was a thinner trade, thinner volumes of trade due to the Easter long weekend around the world, except for Japan. But nevertheless, there was some important pieces of data that did come out, and none more so than the non-farms payroll on Friday in the States. So looking across to the money market here in the States, not a heap of movement since those big moves happened around the banking crisis. The major pieces of data last week came out, consisted of the ISM manufacturing data. So what we're starting to see now is the market's reacting as it should to these data points. So the bad news is usually is a negative result on equities and the like. So we see, a prime example of this was ISM manufacturing index. Now it came out well below the survey. And as a result of this, stocks sold off. Now, during the hiking cycles last year, something like this tended to cause the opposite effect. So if a number came out that was below expected, then you would get a rally in stocks, because that would imply that the market perceives the central banks to limit the tightening that it has to do because of the weaker data in the economy. Now we're at the point where it's likely that the Fed is nearing, and as well as other central banks around the world, they're nearing their terminal rates. No more tightening, and it's just a matter of how the economy is going to stand up to it. So we get data like this. We see usually equity sell-off. So start of the week, not a good week, not a good day for markets. So well down. Jolts the same night came in lower. So S&P was down quite a few, down about 1% earlier in the week. Then moving forward, we had goods orders, that was on the same night, didn't really have a great deal of bearing. ISM, it came out as well, so it was lower again. So that, dampened the mood further. But the biggest piece of data was non-farm payrolls, which is a closely monitored piece of data and notoriously volatile. So it was on Friday night. Now, it did slow from its previous read of 311,000 new jobs, but did come in slightly over estimates of 236,000, and the unemployment rate did drop as a result of a higher participation rate, as we see here. So, yes, stocks jumped a little bit, but we saw more of the moves in rates, just because that number has more of a bearing on the Fed outlook than anything. So you can see here the S&P over the week, it's sort of flatlined a little bit, consolidating. We saw it started off the week in pretty ugly fashion, falling, but since then we had the non-farm payrolls event, and it's regaining a little bit of ground. But this last week and this week we got US inflation coming up as well, which will be closely monitored, as we can see here. So that's tomorrow night. So that's going to be a big event there. So OIS swaps for 3 months came off, obviously back in March, but since then it has been starting to creep up steadily. So that's for the 3-month rate. So it's just under 5% now. So yeah, keep an eye on that, because that could have could see a big move in that if we get a dramatic CPI number. Now bonds, they continued to track lower until Friday. We saw quite a big spike in yield after the NFP numbers came out. So yeah, the fear there is that the Fed's probably going to have to go again, and maybe another hike after that, until those numbers come down. And it's not all about inflation. It's not all about PPIs, CPIs, and the price side of the economy. Employment is the other big factor, and if that doesn't come down, then it's you're fighting an uphill battle. So that's why the employment numbers around the economy are very closely monitored and a very important proxy as to the inflation story. So the Aussie dollar, it's had a pretty mundane month, really. It's been hovering around the 67, 66 marks for quite some time. And it's been very choppy and very volatile, quite a range-bound period. So, yeah, since the start of April, it has come off quite a bit, mainly due to rate differentials. The RBA last Tuesday came out and paused their rates. So they were one of the first economies to pause hiking. So they're sitting at 3.6% for their cash rate. So they didn't hike. They did indicate that maybe needed down the track, but they'd like to steadfast now and see how the economy performs and how it holds up. And if they need to go further, they will. But the lags involved with monetary policy, Philip Lowe, the governor of the RBA, deemed it suitable to pause now. So that's what's happened. Gold has been a really strong performer, mainly due to the economic uncertainty around the world. The safe haven qualities of gold has really played into its own, and it's been able to regain that 2,000. Well, just dipped under it now, but it's been above the $2,000 an ounce mark over the last couple of days, which is a really strong performance, and it's a testament to gold and how it's been able to withstand these very turbulent global economic conditions and the markets at the moment. So the Nikkei, not a whole lot to report. We did have the new governor of the Bank of Japan take over last week, Ueda. So he took over. He said he had a speech yesterday regarding yield curve controls, deeming he won't be tinkering with it too much. However, they would like to get inflation a little bit higher up towards that target and keep the economy stimulated. But he didn't indicate that yield curve controls would be dropped as yet. Hang Seng, it's a similar story to the US equities, really. Just consolidating up at the top of a range there. Whether it can kick on up through these resistant levels, we'll wait and see. But it's may forming a little bit of a bullish flag there. It's bounced back off those lows quite nicely, and we'll see if it can continue momentum up through. I'd like to see it break past this 2100 level to really indicate a bullish move there. On the Chinese today, we did have data came out for its CPI. So as you can see, it's still pretty ordinary, only 0.7% year on year. So yeah, the Chinese officials would like to get that up. They'd like to see, that up around their target of 3%. So it's likely that we could see further stimulus in the economy there, which is good for the world economy, and it could play off as a bit of a counter effect to the poor data that we've seen around the world. It could counter that and maybe add a little bit of positivity there and help that help prop up the rest of the developed world. However, you look at the flip side, and if the Chinese the consumers of Chinese goods, being the US and Europe and Australia, if the demand isn't there, which is indications that it is slowing, then it may, in actual fact, be very hard for China to get their inflation back up. We know they have huge import volumes, and if the customers aren't there, then it can be tricky to kickstart that economy. So it's going to be interesting if what the bankers in China do there. So just looking on the week ahead, I think for me the CPI in the US tomorrow night is going to be huge. It's going to be interesting to see if it continues to keep coming down, whether we get an upward surprise. Who knows? But look, I think if we get anything, around the survey, or I think we need to be focusing on the core number at the moment. But if you get anything to the north of that survey, this is the core CPI here. If we get anything north of 0.4%, we'll probably see these OIS swaps move further right, and these bills might jump back up into the 5% handle. So we'll wait and see what's happening there. But for now, that's all. Okay, thanks guys for tuning in. Really appreciate it, and be back with another edition at a later date. Thank you.